welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Tuesday, February 7th of 2023. We're going to talk about the market insights and observations from Blanke Schein Wealth Management standpoint, what's moving markets. We're paying attention to it, so you should be too. Thanks for watching. So our three topics of the day, we're going to talk about the tight labor market. This has been the prevailing theme of the last 12 months, and what the Federal Reserve is squarely concerned with is that there are too many jobs in this economy. Economy's strong, as evidenced by last Friday's job report. We're going to talk about that. Powell is making the markets move again. If you're watching today, he is in Washington, D.C. at the Economic Club, and he's being interviewed and obviously making headlines and ultimately moving the bond market and the stock market accordingly. And then finally, we're going to finish up today with our earnings update. But let's move along to Friday's job report. Markets actually traded down as it relates to the hot job numbers. We had over 500,000 new jobs added on the non-farm payroll number, and that's right here. In fact, I'm going to go to red to show you the January report that was just announced. And they were expecting just under 200,000. This is double that. So it was a home run as it relates to what you normally want to see, which is a healthy economy. People could find some jobs, but it's not so good if you're Jerome Powell, simply because you're trying to bring the job openings to the job seekers gap down because that's creating a tight labor market. But there was some signs, shades of hope in that labor report, because if we look at the 3-month annualized average hourly earnings, again, keep in mind, they don't want to wreck the economy by by eliminating the jobs. They just want to take the wage inflation off the table. That's the last anchor, or actually piece of the inflation picture that they don't want to become entrenched in the economy, anchored in the economy. But you and I both know kitchen table economics, from gas pump prices to heating of our homes right now, to also egg prices. All those commodities. Sometimes they're seasonal, sometimes they're structural. Those are costing more for everyone, and ultimately, then you're going to have to ask for more with your employer to basically just keep up with the pace of inflation. But the 3-month average, in terms of average hourly earnings, easy for me to say, is trending lower. So it's showing a little bit ease in the inflation report there as it relates to earnings. Now, where's the Federal Reserve going, and what is Jerome Powell actually ultimately saying today? He basically said they're going to continue the pace. They do see some structural changes in inflation coming down, which is a positive, but they're also going to keep the door open for higher interest rate hikes. And one of the questions that was asked, what happens if all of their work, their cumulative effect? Now, keep in mind, last March, they just started raising interest rates last year. And year over year, they're up over 450 basis points, with even more to go later again in March. There's going to be a lot more data points in between, so we can see how the Federal Reserve sort of digests that information to see if there is a lag effect slowing the economy, slowly but surely, hopefully getting a soft landing is what they're trying to engineer. And we're also seeing companies not hire as much or freeze hiring, which would help. But ultimately, this red line right here is what they call the Federal Reserve implied terminal rate, right here, this dotted line. So that's basically where the Fed sees where the interest rates have to be going on the Fed funds rate, their target. And we're still below that. But the good news is that this gap is closing. If you go back to last year, where we were, there's a significant gap from where the terminal rate is ultimately to raise interest rates above the rate of inflation. And now this red line has been coming down over the course of 12 months. And hopefully this red line goes down and then the blue line stays above. And ultimately that's what Paul Volcker did back in the early 80s to temper and ultimately squash inflation and get a handle on it. You have to have basically your Fed funds rate above the current rate of inflation. So if we have inflation rate, this red line keep going down, and Federal Reserve keeps the blue line sort of where it is, a little bit higher, that crossover point is the ultimate goal of where we're seeing where we could see the Federal Reserve take us over the next few months and later this year. Now, this is a real-time chart by FactSet. All the advisors here at Blanke Schein Wealth Management have this on our dashboard, and this is a actual real-time price movement chart of the S&P 500 for just today. Okay, so today's actions, really not much trading. Let's go to here. Let's go to the green so you can see it. Not much trading since we opened at 6:30 Eastern time or 9:30 Eastern time, 6:30 our time. And you can see the price movement. As soon as Jerome Powell started speaking, the S&P shot up because it was positive. His comments were positive, saying the Fed was making some progress. And then as soon as he said they're going to continue potentially more cuts or more rate hikes as it relates to later this year, you could see the reversal in the S&P 500. So the point I'm taking, the take-home point I'm trying to make right now is Jerome Powell, Federal Reserve Chairman, is moving the market. Now, we don't know how we're going to end up today. Also, the bond market was the inverse reaction to this, so rates spiked up again. But that's the real-time action there. Now, let's talk about some highlights here. Over 50% right now, as reported by FactSet, the key matrix. We want to look at the scorecard, the growth of earnings, revisions, guidance, and then the valuation of the S&P 500. Key right now is critical as we saw the S&P 500 year to date up. Quality January, February is looking positive as well as we see, but we're getting up to the 18.4 in the S&P in terms of the valuation, the forward-looking price to earnings ratio. That's one of two things. That's basically telling us that either stock valuations are too high, so there could be some room for a pullback, or earnings have to come up so that valuations can be reasonable value. This is within the 5-year average, but it's above the 10-year average in terms of just a valuation of where we are in the S&P 500. We've seen the 4,200, 4,300 range for the S&P. We'll see if we can hold this range, but we have to have more earnings come in. But 50% of the S&P 500 companies have reported actual results, and over 70% have actually, of those that are reported, positive surprised by 61%. Upside surprised on the S&P 500. So earnings are holding in. Corporations are talking about their forward guidance, ultimately basically being very cautious with their CapEx spending, hiring, buybacks, basically holding their powder dry on the balance sheets, preparing for maybe a soft landing or a potential recession that still hasn't materialized in 2023. We anticipate to see something like that because the Federal Reserve is going to have to go until it breaks something is ultimately what we believe potentially could happen. So we're cautiously optimistic. Corporations are hanging in there with earnings. The top line revenue growth is there, but we also want to see later this year that this is the key one right here, that the earnings growth matter, which is your bottom line. And so can they manage the inflationary inputs, whether it's labor or even all the other COGS, cost of goods sold, inside, that doesn't heat up for corporations, and if they can manage this economy effectively. So again, cautiously optimistic. Companies are doing what they have to do, and they're also providing cautious guidance moving forward. And they're being very prudent in their hiring practices, which all falls into the narrative of what the Federal Reserve's trying to do. So those are our 3 topics up today. Thanks for watching, and like, subscribe, and share to friends and family. Take care.